Hello, everyone, and welcome. It is fantastic to see all of you joining us today for Spacs in 2021. My name is Nicola Corzine, and I am the founding executive director of the Nasdaq Entrepreneurial Center. We're going to get going in just a couple of minutes. But before we do, for those of you who may be new to the center, welcome. We're delighted to have you today. We are an independent nonprofit whose mission is really here to help entrepreneurs achieve their maximum potential and grow. As you may have seen in the chat and in today's opening video, the Nasdaq Center, along with our partner Mentor Cloud, has recently launched a major campaign around mentorship. Now more than ever, we know how much our entrepreneurs are doing for this country and for this world. And so we're committed to supporting our entrepreneurs in achieving their ambitious visions for a brighter, better tomorrow with mentorship available to all. And so if you're looking to gain access to some additional expertise that can help you work through some challenges, we'd invite you to sign up for this platform. You'll see that link again in today's chat, and we're happy to be following up with more information after this. So we're going to be opening up for live Q&A today. So please go ahead and drop your questions into the bottom of the screen that you'll see in the Q&A function. And before we get started, just a moment of recognition that none of this would be possible without our amazing sponsors who literally make all of this possible for us as a nonprofit. So to Lehigh University, Nasdaq, Bank of the West, KPMG, Wilson Sonsini, Woodruff Sawyer, BPM, and NZTE. Thank you so much for your contributions and for all you do in support of all of the entrepreneurs who do so much for us. Now, during these unique times, we've actually been asking over the last year plus now how our entrepreneurs are faring. It has been a turbulent and very interesting last year and a bit. So we're going to launch a poll really quickly just to get a quick sentiment read from all of you joining us today on how you're feeling in today's environment, how you are faring despite the challenges of this year. So if I can ask everyone to take just a moment and let us know how you are doing today. I'm gonna go ahead and share that. Traditionally, as I was providing with our panelists earlier on today, we see a healthy dose of optimism with this crowd always as entrepreneurs. And not surprisingly, that's definitely how we're measuring here. But still understandably seeing a good number that are still working through surviving, and honestly a little bit anxious about the market too. So let me end this poll and share the results. Thank you so much for those of you participating in this. And I've got one more poll before we get started today. And this one is just asking you, what is keeping you up at night right now? The reason that we actually asked this, again, for those of you who may be new to the center, we build responsive programming based on what our entrepreneurs and our community needs. With more than 35,000 founders as part of the Nasdaq Entrepreneurial Center community, we're constantly trying to get smarter around what are the issues that you're facing so we can bring in the experts that can help you block and tackle those issue areas and get back to building those businesses that you're inspired to do. So this will help us figure out over the next 8 to 10 weeks the programs that the center is going to be putting forward. And as always, we like to share the information. So I'm going to go ahead and end this poll and share the results. A good number of you prioritizing both finance and scaling your company right now with team and still working through sales, obviously, through everything that we do. Thank you again for participating, and without any further ado, let's get started with today's session. So please join me in giving a very warm welcome for today's moderator and our panel leader for today, Jeff Thomas, Senior Vice President and Head of Western U.S. Listings and Capital Markets at Nasdaq and Chairman of the Nasdaq Entrepreneurial Center. Jeff, over to you.
It is just an absolutely amazing time to be in the capital markets. You can see the number of SPAC IPOs is just exploding. I think it's important to know when you look at that bar chart on the bottom left, we have now done almost as many SPAC IPOs in 2021 in the first 2 months as we did all of last year. And that was a dramatic increase over what we had the year before. And so then what you can see in the middle bar chart there, that obviously means that the number of SPACs that are acquiring companies is going up dramatically. We've now had over 110 partnership with SPACs announced, and this is really becoming a true alternative to the traditional IPO pipeline. There's over 400 SPACs that are out there looking for targets. So if you're running a private company today, you may be already getting calls from a lot of these SPACs talking about how they could partner with you to bring you to the public markets. or you may be saying, how do I get out there and find these SPACs to start discussing with them? As you can see, a lot of the different SPACs are now out there raising a PIPE, or private investment in a public equity, ahead of a business combination. And so that's about 38% of the proceeds that we see as part of these business combination announcements. That's where additional money is flowing into these companies so that they can power their growth and make sure they have all the resources they need to be successful as a public company. Finally, what you'll see is there are a lot of different industries that SPACs are targeting. So you'll see that TMT, tech, media, telecom is one of the top industries, along with financial services. There's a lot of SPACs out there that are saying, hey, we just want to find a great company. We don't care what sector it's in. And then you can see there are also ones, fewer numbers, that are focused on some of the other industries like energy, industrial, and healthcare. It'll be really interesting to see how that trends over time, especially as we look for some of the recovery as we kind of get to the other side, hopefully, of the pandemic. All right. Well, I hope that kind of level sets that we are in really unprecedented times. And there's a lot of capital out there looking to do deals. So, Aklavia, I'd love to start with you and just kind of hear your thoughts on why would a company think about doing a business combination with a SPAC versus a traditional IPO?
Yeah, thanks, Jeff. That's a good question. I think the SPAC has certainly emerged as an alternative to going public. We have the direct listing, we have the traditional IPO, and the SPAC has certainly emerged as a very popular, in the last couple of years, third option to seek liquidity. Certainly the numbers are staggering, but I would say one thing related to the numbers is that in the SPAC process, you know what the kind of glass floor is on valuation. You know how much is in the trust account of the SPAC. You also can, decipher between all the other deals that have happened, what you can expect in a PIPE deal. That certainly allows for the comfort level to be there for the initial investors, for the management team and the board members, in knowing what the valuation will be. In the traditional IPO process, you don't really know the true valuation until you get to the end of the roadshow process, after you've revealed a lot of the details around, and then also know how many shares, how many millions of shares you've sold at what price point. So I think going into the deal process and going into that de-SPAC process, having a better idea on valuation is very clear and evident. I think the talent that you're seeing on a SPAC sponsor side, and I know we're going to talk about this a little bit later, is certainly really appealing. You've got, legends in their own right in the various industry groups that are launching SPACs, becoming board members of these de-SPACs, and can help to open doors. And frankly, getting this kind of guidance and getting a board that can help the company through a transition in its life cycle, not just for the IPO, but through the growth cycle in the first few years, is a very helpful aspect of the SPAC process that we've seen throughout. And lastly, I would say, it is a great alternative in a low interest rate environment. So the SPAC sponsors are definitely looking at, different advantages on the economics that they can achieve as well. So hopefully that's a good way to kind of kick off the call today, and excited to get any questions later on today.
Great. And Mike, I think one of the other things about a SPAC business combination versus an IPO, a lot of times SPACs and the business combinations are able to provide projections in a much more aggressive manner than the way you can during a traditional IPO. Can you talk about some of the benefits of that as well as some of the risks?
Yeah, sure, Jeff. I mean, if you think about it fundamentally, a de-SPAC transaction is really a capital raising event, but it's structured as a business combination, and the SEC rules related to business combinations are a little bit different and a little bit more lenient than they would be in an IPO context. And so I would say maybe you see me slightly differently. Not only are companies able to, they're expected to be sharing, projections, regarding how they anticipate and what the opportunity is. And that's really the benefit is management is able to speak more naturally in terms of how it views the opportunity that they're to both SPACs, to PIPE investors, and to the public investors at large throughout the offering process. I mean, of course, with that opportunity, there's also risks. Anytime that you're talking about the future, which is inherently more uncertain than so what you're seeing at your company currently, there's a risk that you can be wrong. And and when that happens, you should expect, or there could be a stock drop associated with when you disappoint the market, and the knock-on effect from that is the plaintiffs' firms coming around and bringing litigation. And so a combination of potentially disappointing the market, and certainly the litigation risk associated with those projections are some of the downsides.
Fantastic. And Sherry, you've been working on a number of these business combinations lately. Are there any lessons learned from recent transactions or any key trends you've been seeing?
Yeah, absolutely. Certainly, if I think about it from the SPAC's perspective, a word of advice that I'd have is, with the advisors that you're going to be working with, is to have really open communication around, timeline. And as you're starting to look at targets and maybe get closer to determining who you're going to issue a letter of intent to, I think just that heads up as early as you can is really important to make sure that the team is positioned to support you in the best manner possible. Because I will say there is a lot of activity going on, and therefore a lot of competition for resources and for bandwidth and capacity. So as much notice as you can give to your team, I think that's certainly going to benefit you. If I think about from the operating company perspective, so, same theme, again, lots of SPACs out there looking for, good targets. And so from a positioning standpoint, the more you can do as an operating company to demonstrate your readiness, be that ready to be a public company and having infrastructure in place, or at least be on the path to getting there, having financial statements in order. So really sort of getting the house in order, I guess, and positioning yourself such that you're, as attractive as you can be, because there will be a lot of SPACs looking at you. And so I think, that helps. And then maybe a little bit more sort of downstream into the process. Once the merger agreement is signed, it is all hands on deck to meet the timeline, right? So speed is going to be critical. And so anything that you can do to, help prepare for that and just be positioned to, you're going to be sprinting and, I guess stay healthy, stay well rested, stay well fed, because you're going to need a lot of energy through this process. But I think, just being focused on what you can do to manage timeline, because there will be things that come up that are surprises. But if you've at least managed, 80% of what's out there, that'll help you deal with the remaining 20%. So I'd say those are a few things that I've seen on some of the transactions I've been working on.
Well, and speaking of timeline, Sherry, we do have a question here in the Q&A for a company that's thinking about doing a de-SPAC in late 22, early 23. And they said, hey, we know we have to get our audit done. How long does it take to audit a 2-year period once they get an audit firm on board? What's your best estimate on that?
So it will very much depend, right, on the size of the company. I guess, whether you've ever been audited before, because we've seen scenarios where companies have never had an audit, and then there are scenarios where they've had a private company audit and have to uplift to a public company. But I would say probably a 2-month time frame is pretty realistic and maybe typical of if everything is ready, right? The audit team, I've seen, 2 months be practical, at least to get through 2 years worth of audit. Now it'll vary, but I'd say that's probably a good benchmark to use as a sanity check.
Yeah, and the other part too that sometimes can make a difference is, we've seen with our client base is the industry. So if you're a biotech company that's from a financial perspective is largely just a checkbook, it's usually a little bit faster than revenue generating companies. And the other thing that can often, we've seen it often can increase in complexity is if the company has done acquisitions in advance of the de-SPAC transaction, which could layer on some additional requirements.
Fantastic. Well, of course, as you're thinking about all these, getting the audit done and getting the controls in place, Priya, that kind of comes to the topic of the board. And so I was curious if you could share your perspective on the function of the board, not only of a SPAC, but then also post-business combination. What's the typical structure that you see around the board for a SPAC business combination?
You bet, Jeff. So for a SPAC, the board actually does something unusual that is more muted for an operating company, which is provide some value for the existence of the SPAC, right? Remember that when a SPAC goes public, it's a dream, it's a fairly thin, let's be honest, S1 and the promise of management and the credibility of your board. So there's a lot of pressure on SPACs to have the best possible board they can. The actual duties, what they're supposed to be doing, I mean, it's always the same if you ask a lawyer, which I happen to be. So, care, loyalty, disclosure. But in the SPAC context, I really want to be more specific. And I particularly want to say that for the board of directors of a SPAC, being attuned and aware in a very sensitive way to conflicts, so the duty of loyalty, is a very big deal. There are quite a few SPACs that may be going after related portfolio companies, right? That is an instance where it's fine, it's allowed, but let's all be very, very clear about who's taking the lead about what, and that make sure those conflicts are being revealed. That's really I have no doubt that is an area of growth for the plaintiff's bar right there. For oversight, duty of care, when you're on the SPAC board, right, it is all about making sure that the management team is doing what they're supposed to be doing. And that is, of course, on behalf of the SPAC shareholders, scouring the universe, maybe not boiling the ocean, finding the right deal, making sure that they're running the traps, taking the steps. And a good SPAC board will actually, of course, be on hand to encourage and bolster and even give ideas. But from a fiduciary duty perspective, it's oversight. That is what the board is supposed to be doing. And what we're seeing in the litigation environment is a profound need for documentation around having done it. Right. So it's not enough that the board engage in good oversight. You're also going to want to have somebody take some very good notes, talk to your corporate attorney, talk to a Michael at Wilson, that kind of person, because that is going to be meaningful. That may be more valuable than insurance. And then the last one is disclosure. We all understand that SPACs are an amazing opportunity, carry risk, and have interesting compensation packages. And there is, again, if you're looking for the other growth opportunity for the plaintiff's bar, it's all about the disclosure that will go in the S4 registration statement. And there are two parts to that. There's good disclosure about the target company, and that needs to be accurate and good. And it's also good disclosure about what's the consequence of this deal, consummating this deal. What does that look like from a compensation perspective? Because of course the SPAC shareholders have to vote yes or no on the deal. On the de-SPAC side, it's very common, of course, for one or two of the SPAC board members to go on the board of the target, which will now be a publicly traded company. And that's often one of the reasons you choose the SPAC that you do. You want access to that super fantastic board member, and this might be your best way to get at him or her. But from a duties perspective, it's actually very similar. And for those of you who are on the boards of the target, it's actually the same, right? Look for conflicts, be aware of your oversight duty, and think about the disclosure. I know it is the S4 belongs to the SPAC, but it is all the information of the target. And so the board of the target wants to be right there, making sure that all the good information goes in there. And of course, because I do D&O insurance, I am trying to bring forward action items that we're learning are of great interest to the plaintiff's bar. So that's why I'm pointing out these particular things.
Super helpful, Priya. So Mike, we've got a lot of questions here about the kind of transaction structure. So specifically when you're negotiating a merger with a SPAC, what are some of the considerations around dilution, around fees, and then how is the power shifting between targets and SPACs right now, given that there's so many SPACs looking for targets?
Yeah. So maybe I'll answer the last question first, Jeff. So I mean, it just goes back to the first slide that we showed at the beginning of the program. I mean, there's a ton of supply, chasing a finite number of really quality companies, and so that is definitely shifting power in favor of the operating companies. I mean, the other couple of dynamics that also can often work in favor of the operating companies is the SPACs have a time limit on it. They can only, they have sort of a 24-month runway. And if they don't find an acquisition target during that 24 months, then they have to return, their money, to their investors. So they're on a clock, and that's also, creates a sense of urgency, even for SPACs that are earlier in the life cycle. And then finally, a number of the SPAC sponsors are serial, folks that come back and do additional SPACs, and so that also tends to emphasize the need for speed as they they're looking for new opportunities. In terms of how that plays out, I mean, it will play out at the beginning at sort of the LOI stage, letter of intent stage, where you're going out to usually a number of potential SPACs and trying to create some competitive tension among various sponsors. The principal issue that people are focusing on there is the issue of dilution, which is a function of how the cash that's on the balance sheet of the SPAC correlates to the enterprise value of the target company, and trying to minimize dilution from the perspective of the operating company stockholders. It's a function of valuation. It's also a function of the SPAC sponsor economics, which can sometimes be revisited in the context of a transaction in a way that can be more better from an operating company perspective. And then also the way it plays out is sort of the opportunity for liquidity. And there's often an expectation that the existing operating company stockholders will stay out of the market for some period of time. And depending on the situation, there's an opportunity in the current environment to structure those lockups in a way that speed your existing investors' time to market and time to liquidity, which is often sometimes something that folks are very focused on.
Great. Any of the other panelists have any perspectives on some of the deal dynamics they're seeing on the business combinations?
I'll give a heads up. That's something people who are being courted by SPACs may want to think about. One of the issues that I know we'll talk about later is the cost of your insurance as a public company going forward. We're in an environment where people may, on the SPAC side, are buying insurance and sometimes have a choice about, do they front end the cost of their D&O insurance for the board and officers of the SPAC, or can they put more in the back end? That's a choice. There's nothing wrong with it. It's just a choice. But if you are a SPAC target, it may be worth understanding how much are you going to have to pay for the tail policy, for the D&O policy of the SPAC that's acquiring you. Now, I want to be clear, it's completely customary for the target company to pay that, to pay the cost of making sure the SPAC board has coverage for future claims after the deal closes. That's completely normal. But you want to know how much that's going to be. If you're not a very big company, suddenly finding out that in addition to your cost, you're looking at an extra $2 million, $4 million that you just didn't plan for, that can be a big surprise. It's a one-time cost, but it's a real cost. And it's something that I find that if you're a target and you have a lot of choices, maybe it's something you ask about.
Yeah, just to follow on that, Priya, it's a good point in terms of transaction expenses. I mean, sometimes you'll hear from folks as they're assessing their options that a de-SPAC transaction can be less expensive than a traditional IPO. I haven't done like the econometric analysis whether that's true or not, but my guess is it's not entirely true. I mean, there are a lot of transaction expenses in connection with a de-SPAC transaction. In addition to paying your own financial advisors, you're probably paying, if you're doing a PIPE, the placement agent for the PIPE. You're paying, there's transaction expenses for the advisors on the SPAC side, and usually, or almost always, a portion of the underwriter fees for the SPAC IPOs are deferred until the de-SPAC transaction. So it can all add up, very quickly as you go through, a de-SPAC transaction.
And Clavia, kind of shifting away from the de-SPAC, as we look at how many SPACs are coming to market, what are you seeing right now in terms of new types of sponsors that are coming to market, new structures, any innovations there, any trends you'd want to highlight?
Yeah, I think there's a really good set of new sponsors coming in. So you're seeing certainly growth capital, whether it's PE or venture. You're seeing even kind of the smaller venture firms that really have not done any IPOs, but they're looking at this as a great way to certainly get some public market exposure, branding for their firms. Some of the traditional investors, Jeff, they feel like it could be, conflicting with their LP, so they're staying towards the sideline. Although let's see how long that will last. I think a lot of the larger PE and venture firms are diving head first. Sovereign wealth funds, I think, remain to be seen, but I think they're certainly on the co-sponsoring side. You're seeing a variation of, frankly, sector specialists getting in. So sector-specific energy firms that really have never done any IPOs, but getting into the SPAC world and being very specific around what kind of targets they will set. Seeing that particular in the energy space, and especially with some of the assets that have frankly not recovered pricing wise. There's some opportunistic plays there, and then you're seeing a variation across geographic segments. So we're spending a lot of time with Asia-focused SPAC sponsors. They've been in the SPAC game for a number of years, but you're seeing certainly many more of the prominent firms getting involved, and many of the US-based firms launching SPACs specifically for certain geographic segments. So whether it's kind of Southeast Asia or Europe or MENA. You're also seeing certainly the Middle Eastern investors getting involved. We've had a couple of co-sponsor deals, and I wouldn't be surprised to see some of the Middle Eastern investors getting involved and sponsoring one outright. But if you just imagine the sovereign wealth funds, whether it's in the mature markets in Europe or in the Middle East, if they were to just take a fraction of a percentage of AUM and underwrite a SPAC, I mean, it could be, limitless. So certainly seeing a lot of different sectors. We all see which ones are popular, certainly the EV, ESG, and software and tech in general, but you're seeing, certainly a convergence between several different sectors, and you're seeing that play. And on the geographic side, you're seeing many more as well.
Certainly sounds like a lot of new players, a lot of new opportunity. Sherry, a lot of times as companies are structuring their deal, there's thinking about different options like earnouts and warrants. Curious from the accounting perspective, how should companies be thinking about that, and what guidance could you provide?
Yeah, absolutely. Well, you've hit on the hot topics of the day, at least from an accounting perspective. So there's a lot of focus right now across the Big Four and with the SEC specifically on these topics, and it relates to whether these instruments are classified as equity or as liabilities. And so why that matters is downstream, liabilities require fair value measurements on a quarterly basis. So for the operating company, that's something that's going to impact them on an ongoing basis. But really, I think, what I've seen is there's a shift in how the firms and the SEC are looking at these instruments. And, what I hear time and time again is, well, every SPAC has these, they're plain vanilla, they're all the same. Like if they had equity, why am I a liability? And they're not the same. And what's happening is there's these little tweaks that are happening deal after deal, right? As the sponsors think about different ways to structure the economics. And the agreements are complex. I'll, give a shout out to my attorney panelists here. They are not always the easiest agreements to get through and to really interpret. And so I think it takes a lot of diligence, both on the management team side as well as, the accountants, to really make sure to understand the terms and what's going to drive the accounting. And so what I've seen is, you can't just refer to the past and say, okay, this is how it was done, now this is going to continue, because it's definitely not. So I'm giving you an early warning that there's probably going to be something, coming from the SEC as my expectation on these topics. And, I think one of the benefits, so I'll give a little bit of a plug here for KPMG and for the Big Four. I'm on the advisory side of the house, but we have the benefit of having our national office, which supports the overall firm, that's really plugged into these issues. And so if you're working with advisors who are not Big Four, just be aware that, they won't necessarily have as ready access to kind of the latest developments on these topics. And so I think it's just good to make sure, if your advisor is not Big Four, make sure you're talking to your auditor, assuming they're Big Four. And it's just a timeliness, right? Like eventually this will come out and be a little bit more widespread, but it is something that's very active right now. I mean, we're having almost daily calls, if not, at least weekly with our national office to keep everyone abreast of what's going on. So just one of the fun issues that we're dealing with in SPAC transactions these days.
Well, and you said the magic three letters there, SEC. So Mike, as companies are, making these forward-looking projections, as they're making some bold statements, do you think the SEC is going to come and clamp down on this in any way in the coming years?
Yeah, I'm not sure. I'm not sure. Clamp down is the right phrase, but it's certainly going to get a lot of attention from the staff, and including folks on the enforcement division at the staff. If you think about the market environment that we're in, it's sort of a perfect storm. We're at maybe not the top of the market, but the market is obviously very doing very well. You've got, and that translates into pretty high valuations for operating companies. You do, as you said, Jeff, you have people in terms of their investor education efforts, talking about forward-looking information, and it's also attracting a number of operating companies to being public, which I think is great. But you're attracting companies that may not be as mature as some who might otherwise pursue a traditional IPO, and that translates in terms of sort of predictability, in terms of what their earnings and what their future is going to look like, and so there's just a greater risk of getting things wrong. And then you couple that with the deal dynamics of a de-SPAC transaction, where things move very, very quickly, and you don't always have the same number of people taking a look at the disclosures as you would in a more traditional going public transaction. And so you add all those things together, and I think there's a heightened risk that companies might slip through, or things that might be said in a way that view with hindsight, the SEC or others may take issue with. And and as a result of that, I think it's really important for folks to make sure they surround themselves with the best possible advisors. So when or if it does become an issue, and as I'd like to quote some of my banker friends, I think we're in a period of asymmetric downside risk, that you've got people who are surrounding you doing things the right way, so you'll have appropriate defenses if things don't pan out in the way that you hope they do.
If I could add something on this question of is a wave of SEC enforcement coming, my reaction is the future is here. It's just not evenly distributed. And what I mean by that is they are already bringing enforcement actions, just that it may not be obvious to the world because it's not always announced right away or very openly. And that's how the SEC functions. But they did all of us a favor. And in 2019, there was an extensive release by the SEC about the companyability software. So that was a de-SPAC transaction that may not have been as well diligenced as one might have wished, allegedly. And the SEC was completely clear about their view of the failures of the CEO of that SPAC when it came to diligence, as well as perhaps the intentional failures, who can say, of the target company when they were making statements about, in SEC documentation about revenue and things like that. So it's happening, right? It's already happened. And I do chair Woodruff Sawyer's D&O claims group, and we definitely are seeing activity from the SEC. So I don't think it's a future state. It's just a question of how aware are people of what is already starting to happen. And I would take it very seriously. And one of the issues that concerns me is a lot of people have a belief that if there's litigation, it will only happen after the deal closes. That is not true. The SEC is perfectly happy to come and talk to you before your deal has closed. And so those of you who are doing the SPACs and are kind of thinking, well, I'm okay as long as I can get the deal closed, I would re-examine that assumption.
Well, and Priya, I think that, again, goes back to the topic you brought up before around knowing there's this risk. How do you take the proper steps to make sure you've got insurance to protect, especially your directors and your officers? We did have a question in the Q&A about, for a SPAC that's raising 200 million, how much D&O coverage they need? You talked about the fact that there could be this discussion about who bears the cost of it between the SPAC or the target company. So we'd love to just hear your thoughts on kind of the key trends in the D&O space.
You bet. So the bad risk is the one you don't see coming. And the good news is that the D&O insurance environment is very mature. There are products, people absolutely know how to cover these risks for defense, to think about settlement. And as long as you're working with somebody that actually has an understanding of the claims environment, and you are prepared, sadly, to pay the freight, the premiums are going up, you actually can get a lot of coverage and you can feel extremely secure about your chances for getting your defense paid or having to deal with a settlement with the plaintiff's bar. So D&O insurance exists, and it exists exactly for this reason. So that's the good news. In terms of anybody on the line who's thinking about their own D&O insurance prospects, here are a couple of hot tips. First of all, if somebody is saying that they've got a special magic deal that will save you 50%, the right question is, and what percent of coverage am I losing? There are no special magic deals. There are deals that back end the cost. There are deals where you can, and this is a decision, you can decide, I only want $500,000 of D&O insurance for all my directors and officers of a SPAC for 2 years. And I'm perfectly content for that to accordion after the deal closes. That's a choice. That's a risk reward that somebody can take. It will certainly cost less than if you have a proper insurance program at the front end. And it just, I think I want to advise people to be very clear about what is their goal. In my experience, when people know what the cost is, they plan accordingly. And one of the very difficult things is right now, if you want, let's say, $5 million of D&O insurance for your SPAC, you're looking at $600,000, give or take. $10 million, you're looking at maybe 1 million to 1.5, depending on what you're doing, where are you organized, what is your target, who is actually on your board, those kinds of factors. The key is to start early, to have a good conversation. We just released at Woodruff a guide to D&O insurance for your SPAC IPO. Catchy title, I know. But the whole point of it, right, is to make sure people understand what is the cadence and timeline. And right now it's all about starting early. And as you say, Jeff, there's the other side of it, right? It's the insurance for the operating company that will now be a public company as a result of the SPAC transaction. You'll be shocked to learn that we've just released a guide to D&O insurance for your de-SPAC transaction, again, with the good titles. But once more, it is about understanding what do you want the product to do, and what is the cadence, and what is the timeline. And in both cases, understanding the litigation environment will really drive an optimized outcome.
Fantastic. That's super insightful. And again, I think it is super important for everybody to keep that top of mind. We do have a lot of questions in the Q&A around one topic that I think, Mike, you may have mentioned a little bit, but is going public via a SPAC merger actually faster than a traditional IPO?
Yeah,
Love to hear your perspective and the rest of the panelists as well.
Yeah, I hear that a lot, Jeff. Although I'm not sure that's exactly true either. And I think it may feel like it's faster because so much of the transaction seems to be compressed in the first few weeks in terms of you negotiating with your SPAC to come to an agreement about what your business combination agreement is going to be looking like, and simultaneously marketing your transaction to PIPE investors, while at the same time putting together your disclosure document for the transaction. So it might feel like it's compressed. But when you sort of add it all up in terms of the SEC review and the time that it takes to execute, and then go out to your stockholders to get a vote, I actually think it ends up being basically roughly the same as it would be for a traditional IPO transaction.
Yeah, and I guess, Jeff, what I would add to that, and I definitely echo what Mike was saying. I think if you think of letter of intent through business combination close versus organizational kickoff meeting through to IPO, I think that timeline is pretty similar. Where I think it probably feels longer in an IPO scenario is often, I think the company is planning for longer, right? So they're definitely working before an org kickoff meeting to start getting ready and anticipating what the lift is going to be. And I feel like that time frame is shifted in a SPAC transaction. So they might actually not have been as far down the path of getting ready as, you know, when a SPAC starts looking at them and they start getting excited about a transaction. And so what happens is that readiness time gets shifted to after the transaction closes in a business combination. And that's risky because, you know, you're operating in the public domain. And if you're not quite ready to be a public company and you risk not meeting your first Q or, you know, not meeting the results expectations, that can be really detrimental. And so I think it is a misnomer to think that it's faster. And I think it's important to understand the risk of, if you didn't get the time up front to prepare, when are you going to do that? And what are the other implications of that?
So Sherry, you said that so well. What I think about is when people say, like, what's faster, a de-SPAC or an IPO? My response is, are you asking me how quickly can you throw a wedding? Or are you asking me if you're going to end up in like a tragic divorce shortly thereafter? So like, that's the analogy, right? Like, yay, you're public. And that is exciting for the right company. And there's so many, it's so great, right, for America and capitalism that we have this new way of going public. I think that's terrific. And it just remains the case. If you're not ready, then what are you doing, right? You still have to do the readiness.
Love the wedding and the marriage analogy anytime we're talking about getting in the public markets, because hopefully it's a long and fruitful marriage at the public market.
That's
right. Awesome. Well, Claudia, how about, you know, there is this kind of structure now where, you know, as deals get announced, you know, sometimes the stock will trade up. Sometimes, you know, as you do the pipe, that releases more information in the market, and then post combination, you know, you see kind of mixed results. What are you seeing in terms of how SPACs are trading these days? What are some of the trends there, and what should people be watching out for?
Well, I'll just put it this way, the numbers as of the last 6 quarters have led to the retail community certainly knowing what a SPAC is, certainly getting involved. And combine that with the fact that most of us are at home and have more time to focus on stocks, and the fact that now it's free to trade, I think it's become a perfect storm of events where, you know, SPACs are now understanding that people are willing to pay premium. I think it's just, you know, incredibly notable to see, you know, Liberty Media trading up their first trade at $13 on $10 in a treasury account. If you just think about those numbers, it defies all logic, but it certainly showcases the excitement and the focus and the attention that the buy side as well as the retail community have on SPACs. So you're certainly seeing, you know, investors recognize kind of the, you know, A-tier investors and willing to pay a premium on money sitting in a treasury account. You're also seeing anticipation and obviously rumors out there of deals potentially having a cascading effect on pre-deal announcements, certainly moving on no news at times or based on how the other SPACs are doing. So you've seen case in point many times a SPAC acquiring an EV company, leading to other SPACs that investors feel could be acquiring an EV company trade up on the news. You're also seeing kind of the old adage that whatever goes up very quickly can come down very quickly. So I think all those rules kind of apply as the trading community begins to fully understand the SPAC model, understand and appreciate the structures. And you're seeing that volatility certainly taking hold of some of the SPACs out there. You know, I think at Nasdaq, we've got a great kind of support model for SPAC sponsors in the market intelligence desk, and being able to certainly cut through the noise and give, you know, real life intelligence on what we're seeing. Certainly post business combination, we have this really unique set of tools and services in the investor relations world that helps that target company navigate all the buying and selling activity and have a better understanding and be more prepared as a newly formed public company. So you're seeing a perfect storm of events. I think the investment community will continue to learn from the different kind of chapters you're seeing, and it's an exciting time for the market overall.
Awesome. Well, we are going to open up for a little bit of live Q&A here. We have dozens of questions lined up, so we will not get to them all. In the chat, there is a link where you can sign up for a follow-up session with any of the panelists. If you have a specific question for them or want to connect with them, please check the chat right now and click on that. It's a short survey to get your feedback on the session, and then also hopefully line you up with the right advisor. Mike, one question we have from a number of folks. Can you just kind of walk us through at a very basic level the economics and the compensation for the SPAC sponsors? Are they contributing money, or what is their role in forming the SPAC, and what's their upside look like?
Yeah, I mean, so we tend to focus more on the enterprise side, but at a high level, the SPAC sponsors in connection with their IPO is going to get essentially founder shares, so they'll get a portion of the equity as compensation for organizing the SPAC and going out, finding a target and executing a deal. So they'll get a significant portion of the economics of the SPAC, either through direct equity or through warrants that allows them to purchase shares in the combined company, sometimes at a premium to the $10 $10 price. And the interesting thing about the SPACs is the public investors, the folks that purchase in the IPO, also have a put right at the back end. So the investors sort of have two votes. One is they can vote in favor or not in connection with the transaction, but they can also vote with their wallet and ask for their cash they put into the SPAC to be redeemed, and still hold on to a warrant piece. And so part of what you're paying your SPAC sponsor for is to help facilitate hopefully prevent that from happening, getting good targets, but also potentially providing backstop financing as well, which allows them to also participate or bring side funds to buy shares in the as part of the PIPE transaction.
Great. And Sherry, a tax-related question here, but when a company goes public via SPAC merger, is there any impact on the qualified small business stock capital gain exclusion? I know that's one of the major considerations sometimes for a startup founder that maybe got the shares 5 years ago and wants to take advantage of that.
Oh, that's dangerous, thinking I'm going to answer a tax question. So yeah, full disclosure, I am not a tax accountant. I know we have plenty of very knowledgeable people at KPMG who could answer that, but maybe Jeff, we should take that as a follow-up question, and I can get the right answer to it versus posturing here, if that's okay.
Sounds good. And Priya, a capital structure question. One of the folks asked if you know the answer, but in a typical IPO, the preferred shareholders convert to common. Is that typically what happens in a SPAC business combination, or is that something that's kind of dealt with on a one-off basis? Or is that
it's my expectation that they would, but I think I need to defer to Michael on that one.
Yeah, it's interesting, Jeff. I mean, the expectation is that it will. The interesting thing for most venture-backed companies is that SPAC transactions up until the last several months weren't really a thing. And so if you look at the NBCA forms, they don't even contemplate some of the new technology, whether it be SPACs or direct listings. And we're actually working very closely with the NBCA to sort of to plug that hole. And so the question is, when you get to the point of a transaction, and even it doesn't really sort of, it's a little bit of a square peg round hole issue, that it doesn't sort of contemplate an automatic conversion of the preferred to common. And it really, again, going back to the point I made earlier, although it's structured as a business combination, it's really a financing event, and it usually doesn't trigger a change of control sort of liquidation event provision in your charter, which also might have a similar impact. And so that could be a pretty thorny issue to work through. And on the ones that I've worked on, we spent a lot of time thinking about those issues. It's really kind of unique to how each company's organizational documents are drafted. The expectation would be typically that they would be converting to common, and sometimes you have to achieve that by going out to your stockholders to achieve to get them to agree to that outcome. And if not, you could find yourself in some sort of liquidation waterfall or alternative capital allocation formula. But it is highly dependent on how each company's documents are written. Usually, people get to the point where the stock does convert to common now.
I have to say, I think the point Michael is making points to a meta issue, which is these are still quite new. So you have a lot of people running around doing different parts of the deal. And if you are talking to somebody, an advisor that's only done one or two of these, you are talking to somebody that probably doesn't have the answer to your question. So the fact that Michael can point to this many deals and this is what happens, same for Sherry, same for Nasdaq, right? It actually makes a difference. In my world, in the insurance world, I'm seeing all kind of crazy things that are 100% the result of, and Michael said this so well, it's an M&A transaction that's also a financing event. And if you cannot map the business issue onto the right vertical, whether it's accounting, which I would not begin to understand, or corporate law or insurance, you're going to end up with some really weird outcomes. And I personally have been involved in some unbelievably awkward board meetings as people are now trying to undo things because their understanding is evolving. So I just have to say it is new. And I would spend the time up front getting smart about what you don't know and working with advisors that are doing this a lot. It makes a big difference.
Well, and I think that's a great comment to end on. I certainly hope everybody today on the webinar got a lot out of the advisors we had on this panel. Again, in the chat, you can go in and request a follow-up. I know there's a bunch of questions we didn't get to, and so we'll definitely want to follow up with you all to make sure you get some good advice as you're considering this new alternative to getting to the public market. So please join me in welcoming and thanking all of our panelists, Mike, Sherry, Priya, and Claudia. Thank you all so much for your time. And we hope to see you all back on another webinar for the Entrepreneurial Center soon. Thank you so much.
Thank you.